Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como with Ireland Como Lafoy. Today we're doing a little bit of a secondary video or a special video to accompany our main market update video, and that is going to be about the dollar, Jerome Powell, and perhaps its impact on Canadian ag markets. So, just to kind of lay some groundwork, I think this is probably already well known or at least publicly known. Trump had drafted a letter to fire Fed chairman. He's spoken repeatedly about firing Fed chairman Jerome Powell. And, for the sole purpose of attempting to get interest rates lowered, because Trump feels that, lower interest rates would spur the economy, which isn't wrong. But there has been a lot of rhetoric about replacing Jerome Powell and about reducing interest rates. Um, Again, I think he wants to pick a chairperson who will cut interest rates. Again, he's very motivated to get interest rates lowered and is flexing a lot of muscles in order to get there. So he's putting a lot of pressure on Jerome Powell. He's putting a lot of pressure on the Fed to get interest rates down. I think there's generally support for this from the public, right? Who doesn't want lower interest rates, lower mortgage rates, lower borrowing rates? All those things sound great to consumers and to the average American and even to the average Canadian. Trump even went as far as to say that it should be lowered by 3 percentage points, which would bring interest rates from about 4.25 down to 1.25%. Very low interest rates. But you might be wondering, why is the Fed kind of staying pat and not necessarily looking to lower interest rates? And here's kind of the next Fed rate decision actually is just in over a week and a day. Right now, 97.9%, or call it 98% of the market is expecting no change to interest rates at the next meeting. So they're expecting it to remain between 4.25% and 4.5%. That consensus is actually up from the previous week's probability, where it was only 93.6%. So, you may be asking, with all this pressure coming from the US administration, why is the Fed being so sticky on interest rates? And the big reason, I think, is right now is the inflation rate, which was very, very high earlier, 2.93% through December and January. It went down to 2.8, and then it fell all the way down to 2.3 in April. There was some, during that period of time, there was some interest rate cuts as well, bringing the rate down to where it is now. However, what we are seeing now is some gains in the inflation rate. Those gains are very much tied to the tariffs and things like that are happening um, in the US right now, increasing consumer prices and increasing consumer costs. So, inflation was getting under control. Trade policies now are kind of changing the outlook on that, particularly as it's now being, those tariffs and things are being felt inside of the American economy. All right, let's look at some of the impacts to the markets here. This is the US 10-year treasuries. This is a relatively short term view of treasuries. And you can see that treasuries are rising. What that means is that the market is pricing in a cut to interest rates, even if the expectation isn't for a cut in interest rates, or at least they're pricing in a more of a probability of interest rate cuts further down the line. So I think that the market is expecting, interest rates or Trump's requests for interest rates to go lower to come to fruition. I think that they're not necessarily expecting that in the short term, but maybe more in the medium term and things like that. If you take a longer look at what treasurers are doing, back in March and April, when Trump was announcing the tariffs and the market wasn't really sure of how this would have an impact economically, or even how that would have an impact on trade in US dollars and US currencies, treasury shot up, another 4.5 points on the US treasuries, all the way from 110 to 114 points. So, we're kind of getting, we kind of sunk back towards those lows and now are climbing again. But it is it is evident in these treasuries that the market is still expecting an interest rate cut, even if the rhetoric from Trump is a little bit, uh, or sorry, even though the inflation rate and the statements from the Fed are more hawkish or at least more neutral than Trump would like them to be. So, what's impact that having on the U.S. dollar? We saw a big drop in the U.S. dollar today. It finished the day off at 97.85. It was up near 99 last week. So this expectation of interest rate cuts is having an effect on the dollar. As an index, it is moving lower. And that, of course, is having the opposite effect on the Canadian dollar. Now, we aren't seeing necessarily the same depth of gains in the Canadian dollar as we did see today on losses of the US dollar. But I still think that this poses a risk for the Canadian dollar, or I should say, a risk to Canadian farmers as a result of the Canadian dollar. Generally, a lower Canadian dollar is more beneficial for Canadian farmers. It helps to elevate wheat basis prices, soybean basis prices, corn cash prices, and even canola futures prices. So that's where a rising dollar does tend to have some risks for us here in Canada. And we just wanted to let you know that uh, during this special report. So thanks for tuning in. Again, subscribe to our YouTube channel, and we'll see you again tomorrow.